Good morning, everyone. A very warm welcome to all of you. I'm Alessandro Sanos, the Global Director of Commodity Sales Strategy on our holistic offering of market insights, analytics, and data management. I'm delighted to be chairing this event on carbon, and what a better moment to address this critical topic with COP26 starting in just a couple of weeks. Europe is about to revamp its climate and energy policies to deliver on the Green Deal and meet the 2030 ambition to reduce emissions by at least 55% compared to the 90s level. Our goal today is, wherever you sit in the energy complex, is to offer you a fresh perspective and a new angle on the carbon market that will help you successfully navigate this volatile period. In the next hour, our carbon research team will be discussing what have been the main price drivers in 2021 behind the record high carbon prices, and what will be the key factors to watch entering the winter. What are the core elements of the Fit for 55 proposal and the outlook for European carbon market and carbon prices until 2030? And finally, how is the EU climate policy connecting with the outside world? So to engage with you and take your pulse, we'll have a couple of polls during the webinar and a survey at the end. So please answer in the pop-up window that will appear on your screen. But before we start, allow me to present you our experts quickly. They are all well-known figures in the industry. Hege Fjellheim, our Director of Carbon Research, Ingvild Sorhus, our lead analyst of carbon research, and last, by no means least, Jan Keen, our lead carbon analyst. At the end of the panel, there will be a brief Q&A session, so I would encourage you to submit your questions by using the box on your screen. So without further ado, let's now kickstart this event on the European carbon outlook for 2021. Hege, over to you. Hege, I think that you may be on mute. It seems that we're having some technical difficulties, the beauty of live events. Jan Keen, maybe you would like to start with your part?
Yeah. Hello, everyone. This is
Okay.
Jan.
I'm so sorry. Can you hear me now?
Yes, we have you. Excellent.
Yes, sorry. Good thing we had two machines here, so I could jump over to the other one. So I'm Ingvild Sorhus. I'm working as a lead analyst in the carbon team, and it's very nice to spend this morning with you all virtually when we are going to dive into a bit deeper into the EU ETS and the wonders of the European carbon market. So as Alessandro said, we have the agenda, and I'm going into the short-term dynamics before Hege will move into more kind of the policy nitty-gritty, and then we will have Jan looking into also bits kind of taste on the outside world, especially then focusing on China. So this year we have seen the carbon price have been on a record hunt. I mean, we have constantly been chasing new records. 47 times so far this year, we have seen new record highs being posted. And really kind of why has this all happened? I'm showing this price chart showing the EUA front deck contract, pulled it back to 2017. when kind of a period of time where not too much exciting things were happening in the EU ETS. Everyone was just kind of blaming the EU ETS, saying, well, it's not working, it's not delivering a price signal that will actually drive the shift to a greener economy in Europe. But of course, I mean, gradually the market started to realize that, okay, politicians have made some changes that will actually make an impact and will address some of these problems, especially with this big oversupply that had been kind of haunting the market for a very long time. I think it's worth to kind of mention the kind of one important milestone, and that was the start of the Market Stability Reserve. For those that are unaware of the Market Stability Reserve, I'll kind of explain it really shortly. It's a supply balancing tool. It will kind of soak up allowances from the market. So really kind of addressing this oversupply problem, but it will also be a reserve when it's a tight market and a tight market situation that you will start releasing allowances from the reserve. But I think it's fair to say that this MSR, for short, is really kind of was the superhero of the EU ETS. So of course, kind of in 2018, we saw a tripling of carbon prices. I mean, it doesn't look that impressive now when you look at kind of continuation of prices, how they evolved. But of course, in 2018, you saw prices tripling, and that was much due to kind of this anticipation that we'll have kind of a shorter market and a tighter market when you were starting 2019. So in 2019, we really saw a market where the carbon price was actually working as that it was supposed to do in a textbook example. You had the carbon price, and that was kind of releasing emission reduction potential, especially in the power sector. So in 2019, for the first time in a very long time, we saw the fuel switching dynamics. So kind of the switching between the more dirty fuels towards kind of the more cleaner fuels. And from 2018 to 2019, we saw a drop in emissions in the EU ETS of almost 9%. And that came mainly out of the power sector. And of course, the high carbon price at the time was contributing a lot to this emission reduction. So in 2020, I mean, it was a special year. You had a corona, and that was also special for the carbon market. And carbon market was dropping with all the other commodities, and it became quite evident quite early that, okay, the fundamental picture when you look at emissions in the EU ETS was going to be quite weak in 2020. But still, we had this impressive recovery that, I mean, you had this short dip below or towards kind of 15 euros, and then it quite rapidly recovered. And I think it's like two main reasons for that is, one, you had the Market Stability Reserve in place. So, I mean, even though it was this certainty that you wouldn't have the same situation as the last financial crisis, that the oversupply was building and the oversupply was just sticking in the market, just building and building and building. So now the market had or knows that the Market Stability Reserve, okay, it's going to soak up this additional oversupply that was created by the demand shock last year. Another important element is the Green Deal. In December 2019, the new commission came out and said, Green Deal. Europe is going to be the first carbon neutral, or aiming to be the first carbon neutral continent. And also, of course, if you're serious about carbon neutrality in 2050, 2030 was clearly insufficient on the road to 2050. So going into 2020, we knew that the European Commission would work out a proposal on how the 2030 emission reduction target should be increased in order to be in line with carbon neutrality goal. So that kind of, I mean, as the EU ETS is a policy tool to reach a carbon climate ambition, kind of this realization that it was going to be much tighter market, or a tighter market going forward with a new emission reduction target. So we it came into 2021 on a kind of positive note with kind of support from the policy picture. But then we had kind of the story about this cold spring which delayed the refill of the European gas storages, and kind of the whole story about low gas levels in Europe, and much from the summer we have seen kind of carbon tracking the gas market much higher. So of course much of this increase in carbon prices is also due to a strong energy complex. So since I'm talking about, we have a polling first. You should now see a pop-up window where you get kind of the what will be the main short-term driver for carbon now. So if you take a few seconds to answer that, then I'll continue with my insights. And I'm sorry, if it was better to sing, I would sing a waiting song for you, but I'll keep you off the hook for that one. Okay, so we have the polls are out, the verdicts are out. So thanks a lot for contributing to the poll. Main driver, you think, will be the gas market, followed by policy, to less extent macro, and then weather as well, kind of on the third place. Okay, so good that you answered gas, because my first slide is on the gas market. So of course the gas price is important for the fuel switching dynamics, I would say, in a normal market situation. The chart to the right is showing the aggregated Northwest gas storages, and it's really kind of a good illustration of why we see the European gas market being very tight at the moment. I mean, the green line below, that's kind of the 2020 level, and that's comparing to the previous years where we've seen kind of throughout the summer, we have really seen kind of this a bit stressed gas market. Will we have the sufficient gas that is needed in case of a cold winter? And I think kind of that hasn't eased much lately, and this is why kind of we see high carbon prices. But if looking at the chart to the left, that is really showing the fuel switching price for 36% efficient coal to 50% efficient gas. The green line is showing the EUA price. And if you would get a fuel switching in the power sector, then it requires that the green line is above the blue line. If the green line is above the blue line, then it will be more profitable to run the gas plants compared to the coal plants. This 36% efficient coal plant is not really kind of one of the most modern coal plants in Europe, so it's actually a quite kind of not that too efficient coal plant, and even kind of the least efficient coal plants are in the money at the moment. So let's say that you had fixed gas prices at the same level they are today, fixed coal prices at the same level. It would require a carbon price of more than 200 euros per ton to release fuel switching potential in the power sector at the moment. This is showing for the forward curve, so kind of the shorter dated contracts. So really, there is not sufficient gas to cater for additional demand from the power sector. So really, the fuel switching dynamics is out of the question, at least this winter, until kind of the energy situation improves. Just for illustration as well, I think this is quite interesting chart as well. This is showing the German power stack. And I mentioned that we don't see much fuel switching, but this is really kind of very clearly illustrating it. this power stack shows that kind of it's the dirty stuff in front, it's the lignite that runs, and then you have coal and then gas on the margin. So this is exactly the same picture you would see kind of years ago when carbon prices were more kind of a parenthesis rather than kind of one of the big elements in the energy formation or the energy complex. So we have record high carbon prices, but still it doesn't really kind of change the order of the of which power plants that are running at the moment. So of course, when you have more lignite and more coal, that means more emissions from the power sector, and we estimate that power sector emissions is up roughly 50 million tons compared to 2021 levels. Yes. But recently we've seen kind of the carbon price. I mean, it's not really competing with gas prices, and the gas and the carbon is tracking too closely development lately. And we've seen that the EUA has decoupled a bit more from the gas and also the other commodities compared to what we saw then running up in for instance, August and early September. This chart is kind of indexed. I've indexed the different commodities to the 1st of August to show kind of the performance of the various commodities. And this is clearly showing that kind of the EUA has decoupled from the gas. And why is that the case? We believe there are several reasons why we have seen the decoupling lately. One is that we believe some market participants have had to cut EUA positions to cover losses in the gas and power market. But also that we see rising kind of demand disruption concerns throughout Europe. We've seen kind of struggling fertilizer industry. We've seen kind of other industries that also kind of are announcing that they will kind of scale back production until winter is over with because of high gas prices and also high electricity prices. And of course also, and I think kind of the poll also showed that there are growing worries about policy interventions in the EU ETS. And I think if I had asked this question like in the beginning of 2021, no, I think policy intervention or the risk of policy intervention would probably have moved slightly lower in kind of importance. So of course these three elements are some of the important factors of why we've seen kind of decoupling lately. And then for policy intervention as well, it's much kind of pointed towards speculators and kind of those that don't need to be in this market for compliance reasons. And of course, we have seen kind of the entrance of investors, of investment funds to this market as well. I mean, back in the days when it was kind of perceived as high policy risk, low prices, little gains. I mean, of course, the EU ETS became also interesting when carbon prices were tripling. 2019, when kind of the confidence in EU ETS as a climate tool was kind of renewed. And that made kind of carbon an attractive asset and kind of the European climate policy kind of certainty that, I mean, it wouldn't be less ambitious yeah. So I think kind of carbon is now kind of in a different state and has a different status than it had back in the days. We also see that kind of the EUAs are also used to offset climate-related risk in investment portfolios. So of course, I mean, you have EU ETS as a liquid market and a credible market, and also that we see participants that need to hedge for some carbon cost, either kind of as being or having the risk of being exposed to carbon cost, for instance, under CBAM, or in different jurisdictions or the shipping sector. That's kind of they are also using the EU ETS to hedge for future carbon costs. And then I would say kind of a bit on like short-term policy interventions. I mean, that's kind of one of the elements why we think kind of prices are a bit flatlining around 60. I think it was down to 57 this morning, but anyway. So under the current framework, do the politicians have kind of some interventions possibilities? I mean, there is an article called 29A, which is kind of addressing the speculative move, and if the sharp upward move is kind of not being explained by fundamentals, or if it's kind of suspected that it's speculative driven, then it's a possibility to intervene in the market and release allowances to the market. But there are a set of conditions that need to be met under this 29A, and we don't see these conditions are being met at the moment. So that we don't see, for instance, this Article 29A is very unlikely to be triggered under the current market conditions. Of course, the European Commission came out with their toolbox last week, and their message is really kind of do not touch the EU ETS. It's not really kind of the EU ETS to blame that with the high electricity cost at the moment, but of course they're suggesting to channel kind of more revenues for the EU ETS to soften the burden on due to this high energy crisis. So their kind of commission is pointing more towards kind of that the EU ETS is more kind of the solution than really the problem. But of course, we can't really kind of say that the policy discussions is over. I mean, European Commission is one thing, and then you have the European Parliament and the European member or EU member states that also kind of have the power to actually discuss and put forward proposals on changes. And this week, EU member states or heads of EU member states will meet at the European Council on Thursday and Friday, and high energy prices across Europe will be on agenda. So of course, kind of we could see discussions, or I would suspect that will see kind of continued discussions on the role of the EU ETS and the carbon price. So we don't see necessarily that the short-term intervention is likely, but that the current energy crunch could color the Fit for 55 policy debate. And with that, I will kind of leave up to Hege to discuss more on the Fit for 55.
Thank you, Ingvild. Yes, so we discussed the short term now with Ingvild, and let's now have a look at the longer term out until 2030 and discuss a bit more in detail about the Fit for 55 package and the proposal that came forward from the European Commission this summer. I mean, on the 14th of July, the European Commission published this long-awaited Fit for 55 package, basically revising Europe's full energy and climate legislative framework. And it is addressed to policymakers in EU member states and the Parliament. So they will eventually have to decide in a process that has kicked off, but will really start in the next few months and years. So coming back from the summer recess, policymakers found the carbon market on fire, as Ingvild explained, and have been discussing the energy crisis and high energy costs. So kind of the Fit for 55 discussions have come a bit in the backseat until now. But I will discuss now how just give a quick recap of this EU ETS proposal in the Fit for 55 package, and then also present our price outlook out until 2030. finally discussing some of the policy risks, especially to this Fit for 55 package. So just looking back a bit, December 2019, the new Commission proposed its European Green Deal, more than an emission reduction and a climate project. It's a green transition of the European economy, and really the first step was the proposal of the climate law, which would enshrine the long-term neutrality target into law and also set the pathway towards that net zero 2050 target. When the climate law was put forward, the proposal was put forward in the spring of 2020, and then in September, a proposal from the European Commission of the interim target on 2030, at least minus 55% compared to 1990 levels. This was adopted by or agreed by European leaders in December 2020. A long night resulted in an agreement on the minus 55, at least 55% target. With the Parliament also accepting this, and in the spring. So the climate law was entered into force on the 30th of June this year, 2 weeks before the Commission put forward its package on the 14th of July. So really, that package sits within the big 2050 carbon neutrality plan, and it's a number of legal proposals. So the EU ETS is a key one. It's a proposal to revise the full EU ETS framework, but it also has proposing changes to the renewable energy efficiency, and many other aspects. So let's just have a quick look at kind of an overview over the EU ETS part of this proposal. So I think the main takeaway is that the Commission wants to ensure that the EU ETS stays a key instrument to reach 2030 climate ambition. It's a key instrument in Europe's path till 2050. So really the two keywords here from the European Commission side, not used by themselves, but that's how we see the proposal as such. It wants to strengthen the ETS by making it fit for the 55% target, and it also wants to shield the ETS, because the ETS is seen, as Inge will explain, like finally working, giving a price signal that will lead us towards the targets, the climate ambition that you want to achieve in Europe. And so if you look at some of the key elements that you will see on this slide, first of all, there is the burden on the ETS will be including also then the maritime sector. So it will be increased in order to make it fit for the 55% target. But of course, it will also still be shared with the non-EU ETS sectors. And with a separate ETS set up for transport and buildings, but we're also keeping the member state targets for the non-ETS sectors. So really that is, of course, to count for the different profiles of these sectors and the different abatement cost profiles, but also to shield the ETS from what will be a very tough policy debates we see already on this ETS for transport and buildings. Of course, even more pronounced probably now with the energy situation that we have. Second point is a proposal for a stronger market stability reserve. Ingvild touched upon what this reserve is all about. The idea is to have a supply adjusting tool that will ensure a balanced market. And I will come back to that a bit later, but we'll see that this will be an important tool also for the next decade. So another point from the Fit for 55 proposal is a beef up of the Modernization Fund and Innovation Fund. It's the EU ETS is not only an instrument to reduce emissions, but it's also an important tool for a revenue tool, a cash cow, even more so with high carbon prices. So who should get these revenues, and what should they go to? The split between member states and the funds on the European side is an important topic. So the Commission proposes to increase the size of the Modernization Fund and the Innovation Fund, and also create a social fund with the revenues from the new ETS. Another topical issue is, of course, the allocation to industry. The proposal to phase out free allocation as a mechanism for border adjustment is phased in. Probably this proposal was kind of a bit weaker than many could have expected up front. So catering for the concerns of industries over this phase out of free allocation. Of course, this is also one of the key topics that we see will be very important in the upcoming debate. So let's look a bit more in detail into the different aspects. Of course, the key thing is the reduction of the cap through the linear reduction factor, and now a new element of rebasing the cap. So what you see on this slide is the current cap, which is the yellow line, and the new proposed cap, the blue line, at 4.2% annual reduction of the cap compared to the 2.2% current linear reduction factor. In addition, there is a kind of jump from the old to the new line, which is the rebasing amount, where you will have a one-off rebasing of the cap to make sure the cap comes on this line towards 2030. We assume that this whole framework will be implemented in 2025. Of course, timing is of big importance, and the volume of rebasing will depend on the year of implementation. So that is why we, in our modeling, our estimate is 156 million tons cap reduction in the year of rebasing, which is different from what the Commission assumes at 117, because that assumes a implementation in 2024. Then you also have an addition of the cap, which is not really visible here, of 79 million tons due to the inclusion of shipping. Second thing I wanted to show you has to do with the role of the Market Stability Reserve. So what you see here is basically, like the key takeaway here is that the Market Stability Reserve will play an active role in balancing the market also all the way until 2030. So what you see on this slide is the annual intake into the MSR in all the years until 2030, under three different scenarios. So the yellow one is the current setup, which means that currently the Market Stability Reserve soaks up 24% of the surplus until 2024, and then it will revert to the lower intake rate of 12%. What the Commission proposes in the Fit for 55 framework is sort of a buffer MSR, which would be more dynamic. It proposes to prolong the 24% intake rate all the way until 2030, but with a buffer function, so that when the market gets more balanced, so closer to this upper threshold that is defined in the legislation, then the intake would slow down. the green lines here is a 24% intake rate all the way. So basically, it seems like the Commission proposal, when we model it, is kind of a neat compromise between the current setup and the more aggressive 24% intake rate all the way. The buffer MSR takes in some 20% of allowances more than under the current setup. But as you can see towards the end of the phase, the final few years, the buffer MSR setup will take in much less allowances than even at 12% all the way due to this dynamic function. So this graph shows our estimate for, or historic, and our estimate until 2030 for the emissions in the power and industry sectors. So we estimate that under the new framework of at least 55% emission reduction, 40% renewable, and 38% energy efficiency, as proposed by the European Commission in the Fit for 55 framework, that emissions in these sectors will decrease by 35% this decade. So this is really driven by reductions in the power sector, chiefly, both to the climate target, the renewable target, slightly also to the energy efficiency target, but also national coal phase-out policies, so more structural phase-out of the stack, the coal stack, and renewable policies, of course. So we estimate that power sector emissions are going to halve over this decade, and that renewables will be the dominant power generation source, growing from 38% today to nearly 70% in 2030. So really what the black part here is, of course, industry. So this is not happening at the same pace. So this is where the focus will really be in the coming years, which is sorry. So this is our price forecast until 2030. What I can say about that is that the average 71 euros per ton, reaching close to 3 digits in 2030. So let me just take you through some of the logics behind this forecast. So it assumes that the energy market crunch is relatively short-lived. We use the forward curves for fuels. We also use the Oxford Economics GDP assumptions, and we take more or less the ETS framework put forward by the European Commission as at face value. So we have the linear reduction factor and the rebasing, as I showed in the previous slide. And we also assume that the buffer MSR, as proposed by the Commission, will be adopted. So, so of course, for the near term, Ingvar already discussed that there will be levels around 60, and of course a lot of volatility expected. In the mid phase, a strengthened MSR would play the role to cater for a rapid greening of the power sector. So we will see increased fuel switching once this energy crisis is over in our base case here, and the MSR will really be needed to hold the prices up in this period. So this slide, this line I included to show if we assume that the market stability reserve is designed the way it is today, so no changes to it, which means that the intake rate will revert to 12% in 2024. So really lifting the curve, especially at the midpoint here, towards towards the end of the phase, 2027 onwards. There's a steeper increase of the price, and that is really reflecting the decarbonization of the power sector. There is not that much additional abatement potential left in the power sector, and this is when industrial abatement really comes into focus. And it's really a no mercy system. The emissions have to be under the cap, and that will take so there will need to be triggered abatement in the power in the industry sector, and this is really what is setting the price towards the end of this decade. But of course, a lot of risks to this price forecast. Just want to mention a few of them. Of course, if the energy complex or energy crisis prevails, that would be an upside risk to our price forecast. On the downside, economic downturn, GDP growth numbers lower than what we have in our base case, lower emissions, lower industry production, lower demand for EVAs. To the upside, of course, Ingvild explained already touched upon the discussions about speculative activity in this market. The Commission has said clearly that they have seen no evidence of this, but of course, this as the market, the supply is shrinking with an ever tighter cap, it would this discussion will not go away, and it would anyway could pose a policy risk, because if to the downside, which is what I would go into in a bit more detail. After this whole question that I want to ask you, because we really see a policy risk at the moment. We see the Commission proposal as probably the most ambitious there will be. There will, of course, be proposals to strengthen it, but it's really on the upside. So we see the risk more to the downside. So I wanted to ask you one question as we discuss this buffer MSR and the setup of the market stability reserve. So take a few seconds to think about whether the market stability reserve final design will be in line with the buffer MSR as proposed by the European Commission, weaker than the buffer MSR, or stronger than the buffer MSR. Okay, so here is your verdict. Half of you think it will be in line with what the Commission has proposed, while a third of you think it will be weaker. I think that is, I mean, it's in line with our base, and I think the 30% saying that it will be weaker is a bit different from the last time we had a webinar, where most thought it would be a 24% intake rate all the way, and I think that reflects really the policy risk that reflect the energy crisis, and the policy risk that this could be going over into the Fit for 55 discussions, because policy is not made in a vacuum. And even though Ingvild explained our view that there's not that many levers for intervention in the short term from policymakers, of course the current situation have an impact on the policy discussions which are going to take place in the next few years to finally nail this new EU ETS framework for 2030. So in a high price environment, what will really be the appetite to strengthen the market stability reserve? The strengthening that was put forward and adopted back in 2018 was happening when prices were at one-digit levels, and there was a perception that there was a need for a stronger price signal in order for to make the UTS work and fit for purpose. We're in a very different situation now, so that is one of the risk factors. Same is the invalidation provision from the MSR. This is not, there's a slight change to that in the Commission proposal, but it's not really questioned in much detail. And with concerns over the industry sector costs and squeeze, that is a large chunk of allowances, gigatons of allowances that will sit in the MSR that will be invalidated from 2023 onwards. Of course, that would also be an element that could pop up in the policy debate in the coming months and years. Again, also the Article 29A, what would be would policymakers see that as sufficient as a handle for market intervention, or would they want to introduce a different provision, discussion about price ceilings, etc. Also, the ETS revenues, really important these days, also as a tool to help to alleviate the energy crisis in poor households, etc. So, of course, that is also a big discussion in the upcoming process. Finally, questioning how policymakers would respond to industry worries of a tighter cap and high prices with the proposed gradual phase out of free allocation. So this whole discussion about the carbon border adjustment mechanism is really going to speed up. Now we have the COP26 coming up, of course, not really part of that debate, but still lingering in the shadows. And what we so of course the question is the CBAM already working by being such a big topic in the international community? I want to bring in now Jan, my colleague, to discuss China. So let's turn the lens on the outside world, on China for a moment. Over to you, Jan.
Hello, everyone. Thank you, Hege. So yes, of course, when we talk about carbon market outlook, that's part of climate policy. In terms of climate policy, you all may have read COP26, the climate summit, which will happen in 1.5 weeks. And in addition to EU Green Deal and a lot of net zero targets has been announced, there is a huge amount of focus on China. Will China announce a new ramp up its climate pledge at COP26? And a lot we can expect. And yes, and why it attracts so much attention is that right now it's really 1 year ago, China being the biggest emitter globally, covering more than 28% of global emissions. China announced carbon neutrality targets to achieve carbon neutral before 2060, and also more other climate commitments as well in the past months. So there are really a lot of focus and interest on what will China commit to in the new climate summit. And this morning we just had confirmation that China's really climate envoy veteran, Xie Zhenghua, he will soon fly to Glasgow to attend the conference. Yes, so have a high-level climate negotiator participating. So I think that we'll see really if global climate collaboration can get new momentum. And yes, and everything happening with climate policy will affect carbon market too. And to bring an example, so at the Refinitiv Carbon team, we have been covering a lot on European carbon market and global climate negotiations. And in the past year, we are also expanding a lot on China carbon market research and also China climate energy policy. And why this year, China has launched the national ETS, which covers entire thermal power fleet, covering emission of 4.5 gigaton. So the coverage is already 3 times of that of European carbon market. But of course, in terms of trading volumes, I mean, we're all European market experts. Trading volumes in China's new national ETS hasn't been that high, but I mean, it's for only 3 months when it's entered operation. Here's the price in China's national ETS. Of course, well, I've made some magic to the access, but price was rather steady, around 40 to 60 Chinese yuan, so between 6 to 7 euros. And so just really a fraction of EU ETS price, and daily volumes are not more than 100K ton. And it's also interesting, dominated by occasionally some very huge OTC trades. And feel free to check icon. If you search carbon China, you can see all the latest China carbon trading data and our analysis, etc. But I mean, Heike has already mentioned the CBAM. Well, China's national ETS, I mean, it's been 10 years in the making, but in the context of EU proposing CBAM, I think that really put a new layer into China's ETS. Here's China's emissions by sectors, and where the blue area is China's power sector emissions, and the orange, which is what the ETS currently covers. And the regulator has announced China's ETS in the next 5 years will expand to cover industry sectors, so covering the orange area as well, which will be almost 80% of China's CO2 emissions. But of course, there could be some thresholds, requirements, etc. But we expect by 2025, China's national ETS should cover power and industry sectors and cover at least 60% of China's emissions. So make China's ETS a core instrument in achieving the carbon neutrality pledge. So yeah, I mean, we have in icon Carbon China, we have similar to our carbon neutral content. We have made detailed China ETS supply, demand, and price forecast as well, and with different assumptions on industry coverage too. So feel free to check out. So that's all I can say to have a just broader perspective on what we are discussing today. And now let's move back to you, Heike.
Yeah, thank you, Jan. Just really summing up, short term, continue to keep an eye on the gas market, and fuel switching will be key drivers in the near term. The energy crunch and calls for intervention, not too likely in the short term, not that many levers to actually do that in the legislation, but it will definitely really color the Fit for 55 debate, and I think we'll see that already in the European Leaders Summit by the end of this week and on the extraordinary Energy Council meeting next week. But also worth keeping in mind, the 2030 climate target is not up for negotiation. It's not set in stone, it's set in legislation, and climate neutrality is where we're going. So this kind of predictability of the framework is cannot really be. It is super important for the process going forward, and it can be no doubt that the EU ETS is the key tool to get there. And that said, a lot of nitty-gritties and changes to the EU ETS framework that can be made, and that is what we will keep our eyes out for in the coming Fit for 55 process. So I think we have time for some questions. I will hand over to Alessandro again to run the Q&A session.
Thank you, Hege, and thank you, Ingvild and Jan. We received many questions in the chat. Keep sending them, so even if we don't have the time to answer all of them, we'll be reaching out to each of you. Probably one question that is in the chat that builds a bridge between EU and China. Give me just 1 second. So how do you see the current power cuts in China with regards to the EU ETS? If products are not supplied anymore, do you see a reverse in the ambitious climate policy there and in the EU?
Yeah, so I'll take it. Yes, so there are power crunch in China, which has escalated since late September, with over 20 provinces has put in place measures curbing industrial power production and even affected residential as well. And as the short-term response, Chinese regulators has required enterprises to boost up basically fossil fuel output and imports as well, really to ensure energy security. Yes, as for the status, I mean, we have written detailed analysis in ICON as well. Feel free to check out. And as the status now, well, it has improved. Thermal power capacity has improved, etc. But there are, as we have a power shortage tracker, there are some provinces are still having industrial curbs in place as well, because I mean we all see it's not an issue in China, it's globally, and we expect this to continue, the industrial curbs or like this partial industrial production curbs to continue into Q1 next year after the winter heating season. And yes, it is disrupting China's exports and also has impacts on global supply chain from raw materials to silicon production, etc. And I mean, this occurred in the same time we're talking about demand destruction in Europe. So it is, again, a global issue. But of course, with Chinese industrial production being affected, this have a larger impact. And to summarize, yes, I mean, in the past months, what is happening as in the energy crunch is having some impact on definitely climate policy. I mean, with policy in China, the policymakers putting ensuring energy supply as top priority. And of course, that is shifting the policy focus a little bit, but we do not expect this to affect China's, let's say, mid to long-term climate commitment. So because that's carbon peak and carbon neutrality, and also again a more volatile fossil fuel price is also not a good argument to move away from it to speed up the green transition.
Excellent, thank you, Jan. And I know that we're approaching towards the end, but probably if people could stay for 5 additional minutes so we can go through some of the questions that are coming through. Ingvild, Hege, I think this one probably is for you. Looking to the next 3 to 4 years, what level of abatement do you see still remaining in the power sector?
Yeah, that's, I mean, going down the lane, we will see kind of the power abatement being exhausted, but that's not taking place until, what we think, 26, 27. So I think kind of for the next 3 to 4 years, we believe kind of an abatement from the power sector of 40 to 50 million ton per year. I mean, we have a maximum potential that is larger, but we believe that it will require around 40 to 50 million ton of abatement in the power sector for the next 3 to 4 years.
And there is also a question with regards to the EUA's prices. Would prices around 200 euros levels be beneficial for the energy market?
I think kind of looking at, we are at 60 now. Of course, it's a stressed gas market and coal market as well. And it's not the best moment to say that it's 200 euros would be kind of the answer. Of course, it depends on kind of the time horizon when you will get a carbon price of 200 euros. And of course, going further out, when you have a cleaner power sector, of course, the carbon component of the electricity price will also be lower. But of course, I mean, 200 euro carbon price, that would make the investment case for a lot of technologies, also building out the renewable storages, like more like CCS, hydrogen. Of course, a carbon price of 200 will make that investment case much easier. But if it would be kind of beneficial in the short run, most likely not. I think that will be difficult for policymakers and difficult for industry and power companies across Europe.
Thank you, Ingrid. And you mentioned during the presentation earlier demand disruption. Do you have some quantification of this demand disruption in the industry sector? Do you believe that it is serious enough to affect the current carbon price?
I mean, currently we kind of see it's offsetting some of the power sector or increase in power sector emissions, but we haven't kind of looked very much into details on the amount of demand disruption from the industry sector. But of course, I mean, if this lasts, right? If this lasts also kind of throughout the winter, and you will have an industry sector that is hampered by high electricity prices and need to turn down productions, of course that will have an impact on the carbon price. That's also kind of, I mean, they receive free allowances, maybe need to offload allowances if they're cash constrained as well. So of course, kind of lower demand from the industry sector as well will be kind of a downside risk to the carbon price.
Thank you. Still trying to squeeze another question maybe. Is the MSR capable of promptly releasing allowances in the reserve if prices remain unusually high? And what would be the trigger price for this?
Yeah, it's, I mean, good question. How it is set up now is that MSR is not kind of triggered by price. So the price could be whatever, because the market stability reserve and how it operates is only based on how much supply is in the market. So it's not responding to price increase. And of course, that is something that, I mean, I've seen someone asking for that, like that could be kind of a solution, that MSR maybe should respond to some price spikes or whatever. I haven't really seen kind of firm proposal on that, but of course that is, I mean, that could of course also come into the policy debate when you're discussing the framework and how the whole legislation should look like going forward. If there should be something that responds to a more kind of dynamic to price changes, if that's going to be MSR or something else, like a price floor, price collar. I mean, that is something that might pop up in discussion. If we'll get it in the end, that's far from certain. But we will see kind of a lot of various proposals going forward from various stakeholders. I think that's for certain.
But it's important to bear in mind that this is kind of for the long term. This is not the current legislation, and it takes time to change the legislation. So it's not the possible response to the current energy crunch.
Thank you again. Thank you, Ingrid. So we have so many questions in the chat. We will be answering those probably on a one-to-one. And I think that this brings this virtual event to a close. So let me thank you for joining this webcast, and Hege, Ingrid, and Jan for sharing your insights. Thank you, and stay safe.
Thank you.
Thank you.